fair value hedge of inventory. Our company reports commodities inventory on our balance sheet at $1 million. The inventory has a fair value of $1.1 million, and we're concerned about a forecasted decline in the commodity price. We have a financial derivative in order to mitigate this risk. On the last day of the period, the fair value of the inventory has declined by $25,000, whereas the fair value of the derivative has increased by $22,500. All of the inventory is sold at its fair value, and the derivative is settled on the last day of the period. Complete the following table of the required journal entries during the period. Use a negative sign with your answers to indicate a credit entry. So, to recognize the change in the fair value of the derivative. And so that would be the 22,500 with a credit, so a negative a negative 22,500 on our earnings. Recognize the change in the fair value of the inventory. So inventory, we need to have a negative 25,000 and indicating the credit to inventory, and then the positive 25,000 on the earnings. Recognize the revenue from the sale, and so this will be cash of $1.1 million minus that 25,000 fair value decline in inventory. And the credit to our earnings. Then recognize the cost of goods sold relating to the sale. And so that's going to be our inventory and earnings here again. And so we'll do the 1 million minus the 25,000 decline in inventory for 975,000, and then recognize settlement of the derivative. That's that 22,500, and so a debit to cash for 22,500 and a credit to the derivative. And then here for the totals, we can obviously just do a sum function. And then I'm actually going to change this because it hurts my eyes so that we can see it with the comments there.